Greetings, everyone. Today, banking in the United States and how it is we got to the point that we are at. Now, one of the things we looked at when we talked about money that you should have done a couple of days ago or just right before this or whenever, who knows, asynchronous means that time has no meaning any longer, is that the use of money as we use it now is very different from how it has historically been the case. This is including banks also, right? How we do banking is different from how we've done banking in the past. Nowadays, you think of, the big banks and stuff like this, or some of the smaller ones around here, but it hasn't always worked like this. Okay? In fact, the way we have money does not always work like this either. You look at the money now, it's Federal Reserve notes, right? So these are bills that have been issued by the Fed, the central bank. But man, that thing didn't even get created until 1913. We didn't have a central bank up until that point. Instead, we had a far different system, and our monetary system was very different also. So what we used for money and how we thought of money was a very different thing from how we're doing it nowadays. So what have been the big differences and the separations here? It's been wars, it's been panics, it's been politics, has changed how banking and money has worked in the U.S. over time. And so we have these different eras, right? First Bank of the U.S., Second Bank of the U.S., State Banking Era, National Banking Era, Federal Reserve Act. And I see the rough time periods there. And this is just stuff to kind of give you the background of how it is we got to the point that we're at right now and why the Federal Reserve was created. So I'll go through it relatively quickly. I mean, you have the PowerPoint. If there's anywhere you want to pause, you can do that, fast forward, what have you. All right. So we'll go all the way to the way back when, to the colonial period. We didn't have any money. We used other people's money, specifically British pounds, French francs, Spanish milled silver dollars. All right. So we're colonies. We didn't have our own money. We used theirs instead. Those were the big colonial commercial powers at the time. All right. But we didn't have enough money to go around. And when we're importing goods, which the colonies did a lot of, that meant you had money leaving the country. And this is back when money was made out of actual gold and silver for the most part. So it would leave. Now, issuing paper currency was illegal in the colonies, but we did it anyway. Because America. So this here is a pamphlet by Ben Franklin. It says Ben Franklin or somewhere on there. I guess it doesn't. Well, he did this pamphlet anyway. Okay, where he was advocating for paper currency, which makes sense because Franklin was a printer, so he was going to make money by making money. Ha ha. Yeah. All right, so here you have one of these notes. It was printed by Ben Franklin. He made sure it said so right there. He even used leaves in the printing process, which was this innovative thing at the time. It was anti-counterfeiting measure. Here we got the pounds and the Spanish milled silver dollars, right? So this is representative money here, right? So this is what this was representative money, all right? So you could exchange this for a currency that was actually gold and silver. That was the commodity currency. So you could exchange this for 4 British pounds, the actual coins that were made out of precious metals. And over here you could exchange this one for 6 Spanish milled dollars. Which were going to be silver, so again, precious metals. But this created an exchange rate between the different colonies because they're doing representative currency and these different other currencies. When the Revolutionary War comes along, we print our own money called Continentals. They printed way too much, which caused inflation and made them worthless. There was a saying at the time, it's not even worth a Continental, which many were saying was really not worth anything. All right. The Revolutionary War is over. We got problems, shortage of money, no uniform currency. There's a bunch of debt that is taken on here. Yeah, here you see the very first coin that was minted in the U.S. under the Articles of Confederation called the Fugio cent, because I had the word fugio in Latin right there, which is Latin for flying or fleeting. All right, and I like the first the slogan on the money: "Mind your business." We should go back to that. All right. Although you gotta see what the message is on the coin here, right? So fugio means flying or fleeting, and you got this sundial here. So the message was time flies or time is fleeting. Mind your business. And here they meant business in a much more literal sense, right? So your actual commercial business or your affairs, right? Time is fleeting. Take care of your affairs. Take care of your stuff, right? It wasn't in the mind your business sense that we use it nowadays, butt out or anything like that. They're using it in a more literal sense. Then on the tail side here, you have the 13 links, and we are one. All right. So Alexander Hamilton, you've probably watched the musical, so I won't get into all of that, right, and how he got in a duel with the vice president and all that stuff. But Hamilton was the first Secretary of the Treasury and helped set up the U.S. financial system in the U.S. and the first coinage system and denominations and all that stuff. A very, very influential founding father in general, again, just in the musical, but also because he was a financial genius and set up a few banks. But he was the first Secretary of the Treasury. He was also the leader of one of the first two political parties in the U.S. He was a leader of the political party called the Federalist Party, and the other party was called the Democrat-Republican Party, which is a little bit confusing for us. But it was Democrat-Republican Party, and Jefferson helped lead that party. Okay. When it came to creating a central bank, a nation's bank for the country and the government, Hamilton was all in favor of it. He saw the Bank of England worked with the British system, wanted that for us, and he wanted more of a centralized style of government, and Jefferson was the opposite. He didn't want a commercial entity that was going to have as much power as what a central bank would have had. So they went up against each other. And here you have what James Madison said, right? He's the guy who wrote the Constitution for the most part, right? He said a central bank was condemned by the silence of the Constitution, was condemned by the rule of interpretation arising out of the Constitution, was condemned by its tendency to destroy the main characteristic of the Constitution, was condemned by the exposition of the friends of the Constitution whilst the benefit of the public, was condemned by the apparent intentions of the parties which ratified the Constitution, was condemned by the explanatory amendments proposed by Congress themselves to the Constitution. So what do? We make one anyway. All right, first Bank of the United States. At that time, it was just called the Bank of the United States. Yeah, really what Madison was saying here is Constitution doesn't specifically, explicitly give Congress the power to make a bank like this, so therefore we can't do this. But, general welfare clause and elastic clause will stretch things a little bit. We created one. So the Bank of the United States, and 20% government owned, 10% foreign. You didn't write down those details or any of that stuff. The missing 10% was U.S. public owned. Right, located in Philadelphia because this was the nation's capital at the time, financial capital. Had 8 branches, 20-year charter. I'm going to be using the word charter here and there. Charter just means license to operate. So it was given a 20-year license to operate by the federal government. That's where the branches were along the eastern seaboard, major port cities. Now, what did it do? It was the government's bank. So the U.S. federal government put money into the bank. That's where it kept its money. That's where bills got paid out of. The Bank of the United States issued money. So it created banknotes, right? So paper money that was representative. You could take these banknotes down to the Bank of the United States and exchange it for gold and silver, right? You yourself could deposit money in the Bank of the United States as well as take out loans from the bank. So it operated as a kind of a private bank as well. Yep. Now, it wasn't a central bank the way we normally think of it. It did do a little bit of monetary policy. We'll worry about that some other time. But when its charter was up for renewal in 1811, Federalists, Hamilton's party who supported it, they're no longer in control of the Congress, and it fails by 1 vote in both chambers, and so the Bank of the United States fails to exist. This becomes a problem the next year because it was the War of 1812. Wars are expensive to be able to prosecute. And not having a bank turned out to be rather inconvenient. Had to operate through a bunch of state banks, which were not terribly secure during the middle of a war, where the war is being fought on your land. So James Madison is the guy who was in charge at the time. He was president of the U.S. during the War of 1812, the guy who condemned it, and condemned the central bank, and so he suddenly comes to realize this would have been a good thing to have, and he changes his tune from saying condemn to maybe we can do that. So we created another Bank of the United States, the second bank. What we now call the second bank. You see the stuff there. 20-year charter again, more locations and branches around the country because the country's been expanding. Did all that stuff. Had all the same responsibilities as what the first bank did. At the same point in time, you see state chartered banks taking off. So the Bank of the United States was the only one that was chartered, given a license to operate by the federal government, the national government, but state governments were also chartering banks. So you see those increasing in number. We got panics that are happening in part because of currency issues and people panicking. It's the term financial panic. You have runs on the bank. People freak out. They go down to the bank, try to get all their money out, which causes banks to collapse. And then credit freezes up and financial houses go under. All right, so bad stuff. And this happens a lot. All right, so here you have the Bank of 1819. we'll have the Panic of 1825. We've got the Panic of 1833 to 1834. And then eventually, when the Second Bank of the United States is up for rechartering in 1836, it unfortunately was facing Andrew Jackson, who was president at the time. Andrew Jackson did not like banks, and what you actually have during this period was called the War on the Bank, where Jackson was actively working against the Bank of the United States and withdrew all the federal money from the Bank of the United States and stuck it in state banks. It did not help that the president of the Bank of the United States, a guy named Nicholas Biddle, was supporting Jackson's opponent, and there was all sorts of political machinations going on. But Jackson wins the re-election, and everybody knows that the charter will not get renewed because Jackson will just veto it. So, Second Bank of the United States dies, and we enter into what's called the state banking era, or the free banking era, which means that there's no national government bank involved. Instead, all you have are a bunch of state-chartered banks, banks that give them license to operate by the various states, and is the states that will regulate those banks. So the states are in charge of licensing the banks as well as regulating them, and some states were, let's just say, better at regulations than other ones were, and creating good regulations as well as enforcing them. Some of them really hardly did any sort of regulation. Okay? And banknotes explode. They look like this. Because what's happened in this time period is that each and every individual bank was creating its own money. Okay? So it had the coinage, the commodity money that was made out of gold and silver, but then based on that, the state banks would print their own paper money, which was a representative currency. Where if I had this $1 Beverly banknote, I could take this piece of paper down to the Beverly Bank and I could exchange that for a $1 gold coin. All right? And that's how it operated. I could take this $5 banknote down to the Central Bank of Pennsylvania, and they would give me $5 and $1 gold coins. Okay? So I didn't care about the paper money. I cared about what it backed up, what it was backed up by. Now, where this gets confusing, though, is there were different requirements, right? So different states required that that their banks had different levels of specie reserve, which means, let's say in Louisiana here, it was around, let's just call it 50%. So what that means is that a Louisiana bank could issue $100,000 in paper money and only have $50,000, 50%, to back up what it had issued, $50,000 in gold and silver coins. All right? Or Alabama here, those banks could issue $100,000 in paper money and only have $30,000 in gold and silver coins to be able to back up the paper money they had issued. Right? Now remember, you don't care about the paper money itself, you care about the fact that you can exchange the paper money for the gold and silver coins. So you value that only as insofar as you think you can actually do that. Right? So this is where we had some problems, like, go back up here. Let's say you walked into a bank in Philadelphia, Pennsylvania with a $1 banknote from a Tennessee bank. That Philly bank would redeem that for only 80 cents on the dollar. If you walked in with a $1 banknote from an Illinois bank, they would have redeemed that for only 50 cents on the dollar. And there were two reasons for this. One was that, well, you actually had to get the note to the bank itself in order to redeem it for what you really cared about, the coins, which meant there was going to be transportation costs involved, transaction costs. The other aspect is, well, okay, look at the Tennessee bank right here. They had about 30% specie reserve requirement. Down here in Illinois, it was like 5%. Illinois banks had issued $100,000 in paper money and only have $5,000 in gold and silver to back up all that paper money. Now, that meant you were taking a bigger risk by accepting Illinois banknotes, right? Because what if you took those and you go down to the Illinois bank and they're like, oh, yeah, don't have that on hand. Can you come back later? All right? So you could wind up taking paper money that could wind up being absolutely worthless. So that's why the Philadelphia bank wouldn't redeem the Illinois banknotes for the same rate as with the Tennessee banknotes, right? You were much more likely to be safer with the Tennessee banknotes. All right, banking in Texas, we didn't do it. It was actually specifically outlawed by the Texas Constitution. Let's fast forward. We got panics here in 1837, another panic in 1857. And then along comes the Civil War. Wars tend to change things. So this became a problem, right? So you had half the country going off and rebelling, and then two sides are going to go to war with each other, and this creates lots of financial strain. Wars are expensive to be able to prosecute, and we've got to get the money from somewhere. Okay, so what does the federal government do? It actually starts to print legal tender. It starts to print fiat currency, greenbacks. So instead of being representative money, or just straight commodity money made out of gold and silver, we create legal tender in order to pay for all the stuff that we needed to pay for in the pursuit of defeating the South. All right. Now, in the process, there are banking acts that are passed. Basically, the federal government is trying to take over from the states for chartering and regulating banks. They're also trying to get rid of paper money. All right. And now the federal government can just outlaw the state banknotes that were issued by the state chartered banks, but what they could do is tax those banknotes. So they put 10% tax on all state chartered banknotes, which meant you could either use the new national currency, the new national paper money, and it would be worth $1 on the dollar, or you could use the state chartered banknotes, which would be worth only 90 cents on the dollar. So which one are we going to use? National currency, right? So basically they were taxing the state banknotes out of existence. State chartered banks get around this and survive, though, by creating demand deposits, checking accounts, basically, where instead of giving people a piece of paper that said you had a claim on a certain amount of gold and silver at the bank, now you can write on a piece of paper that says so-and-so has a claim on a certain amount of money I have on my account at that particular bank. So we have a dual banking system. So you want having state chartered banks and state regulated banks, and you also have nationally chartered banks and nationally regulated banks. This is a much more complicated system than we see in other countries, but it's how it's evolved historically over time in the U.S. There you can see some Civil War money, right? So we have a new national currency that is backed up by U.S. government debt, right? And I'm not going to get into details, but the Bank Act was also a clever way to get banks to loan the federal government money in the middle of the war. So create money and get loaned money at the same time. So there you got some of the national currency banknotes. Panic of 1873. One of the things that we wind up seeing a problem and the currency becomes a big issue is the gold standard, because those greenbacks, when they start taking those out of circulation, they start increasing in value. This is a problem for farmers in the West because farmers were in a lot of debt to the commercial centers in the East, right along the eastern seaboard. So they owed them a bunch of money, but they have to pay them with increasingly valuable money. After we started getting rid of the legal tender and then went back onto the gold standard. So it increased the value of the money, which meant that farmers had to pay back their debt using more valuable dollars than what they had initially borrowed. So farmers are getting screwed on the deal, and the commercial centers in the East are benefiting from it. And here you have a very much a regional geographic conflict going on here between the East and the farmers in the West, especially. It all had to do with what we're going to base the money on. We're going to base it upon just gold, that's what the gold bug said, or we're going to base it upon both gold and silver, which is what the bimetallists or the silverites wanted. The silverites wanted it based on both because that meant we could print more money and you would purposely inflate the money, which would cheapen the value of the currency, make it less valuable, and therefore help with those constituents in the West. In order to pay off their debt, and they also argued that would actually benefit because people would have money to spend, right? Which is it's an inflationary problem. People think that it benefits and it'll get a short shot in the arm for the economy, but it very quickly goes away, it becomes a problem. Anyway, so we got other panics here, 1882, 1885, when road construction started to stop and slow down. You had Panic of 1884, right? Panic of 1893, which set off the worst depression until the Great Depression. 1893 was a bad year to be a banker. Right, we have the gold standard versus bimetallist standard, which just mentioned. This was a big deal in the election of 1896 when we had William Jennings Bryan, who was the bimetallist, the silverite, versus William McKinley, who is a gold bug. If you remember your U.S. history, you might remember the Cross of Gold speech from last year. Okay, and then the final straw is the Panic of 1907. You have the Knickerbocker Trust Company going under because it had a silly name, and it takes down lots of other financial houses with it. Many banks failed, the economy shrinks, money supply shrinks, U.S. goes into recession, and in fact, the banks, led by financier J.P. Morgan, had to bail out the federal government, which is somewhat ironic. 100 years later, it was the other way around. But there, it was the banks, mainly out the federal government. The story is Morgan got a bunch of other bankers in the room and got them to basically said he wouldn't let them leave the room until they agreed to loan the federal government money. And if Morgan said he should do something at that time, he kind of went along with it. All right. But all this led up to the creation of the Federal Reserve in 1913, the Federal Reserve Act. So it was staggered dismissal. It was because of all these financial problems and all these panics and all this monetary uncertainty that the Fed was created in 1913. So we finally created an actual central bank at this time period, and this is the era that we live in now, which is the Federal Reserve era. And this is how you think of money nowadays, is simply because of the Federal Reserve and its creation in 1913. But this was not something that existed before then, and so we didn't think of banking or money in that same way at all. I mean, imagine we saw all those state-chartered banknotes, right, where you had Bank of America creating its own paper money and Alliance Bank creating its own paper money. You know, that's how it worked back then. And instead, you use that nice uniform Federal Reserve note, and this is what we're used to. All right, so the next time will be about the Federal Reserve itself.